Happy Sunday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. It's been a big week. We have an extra episode on the weekend, so we're caught up as we move into what will no doubt be another big week of developments. So, with that said, let's jump in. As US President Donald Trump revives a sweeping tariff strategy, nations around the world are scrambling to avoid being caught in the crossfire by offering up a familiar concession, buying more American goods. Since Trump's announcements on the 2nd of April of sky-high reciprocal tariffs, temporarily paused until July, over 70 countries have entered negotiations with Washington. Many are pledging to reduce their trade surpluses with the US, hoping that ramping up purchases of US products will ease pressure from the Trump administration. But the effectiveness of this buy more strategy remains uncertain. Vietnam has moved swiftly to court favor with Washington, finalizing a $300 million Boeing jet order and authorizing Starlink, the Elon Musk-owned satellite internet provider. The company also accelerated approval of a $1.5 billion Trump-branded resort. With a $120 billion surplus in trade with the United States, Vietnam has ample incentive to stay on Trump's good side. Other countries are following suit. Thailand is increasing corn feed purchases. Europe has floated boosting soybean and LNG imports, and South Korea is dispatching a delegation to Alaska to revive interest in a $44 billion liquefied natural gas project that Trump called truly spectacular. Meanwhile, Japan and the UK are among Washington's top negotiation targets, with Tokyo already sending trade officials to Washington and London exploring a deal that Vice President J.D. Vance described as having, quote, a good chance. End quote. Israel has also made a strong gesture, with Prime Minister Benjamin Netanyahu promising to eliminate the nation's $7.4 billion trade surplus with the US. And even countries like Zimbabwe, without the means to splurge on American products, are pledging to remove their own tariffs in a show of goodwill. Trump's strategy mirrors moves from his first term, when Beijing halted trade escalation by agreeing to boost US purchases by $200 billion. But that deal ultimately fell short. It is likely no coincidence that the US administration has gone hard on China this time round, and though most reciprocal tariffs with other nations have been postponed while negotiations are ongoing, those on China have not been. Indeed, they have increased over the last few weeks. Now, administration officials, including Treasury Secretary Scott Bessent, want more. Major investments in the United States, dismantling of non-tariff barriers, and coordinated steps to counter China's economic dominance. Quote, while splashy purchasing announcements are welcome, they are often short-lived, end quote, warned Wendy Coulter of the Asia Society Policy Institute, adding, quote, structural changes are harder, but ultimately more meaningful. End quote. Some developing nations, such as Cambodia, face limited options. With a $12 billion trade surplus dependent on garments and footwear, equivalent to a quarter of its GDP, Cambodia can only offer narrow concessions, like market access for US agriculture or relaxed data rules for technology firms. Others, like Canada and Mexico, already top the list of US buyers and are unlikely to avoid the minimum 10% tariff. Much of Latin America also faces similar limits, despite buying more than it sells to the United States. In Asia, India has pledged to quadruple trade with the United States to $500 billion and increase defense purchases. Yet past negotiations under Trump floundered. Quote, this time we're serious, end quote, said Indian Foreign Minister S. Jaishankar. China, however, remains the outlier, with tariffs exceeding 100% and no meaningful dialogue yet underway. This is an ongoing space that we've been following very closely on my other channel, China Update. Peking University Professor of Finance Michael Pettis argues this week that getting foreigners to buy more American stuff may seem like an obvious way to resolve US trade imbalances, but it isn't, saying that trade clears systemically, and without changing the domestic policies that drive savings imbalances, trade imbalances won't change. He expressed in a note, quote, if foreigners agree to buy more specific goods from the US, this simply shifts US imbalances between countries and sectors, without changing them in the aggregate. That's because as long as they produce more than they can invest or consume domestically, they must run trade surpluses. And as long as they choose to balance these surpluses by acquiring US assets, or as long as the US permits them to do so, the US will run the corresponding deficits. Trade doesn't balance on a sector-by-sector or country-by-country basis. Either we need a trading regime in which countries do not compete by suppressing domestic demand, or one in which the US and the UK and Canada stop accommodating global savings imbalances through their open financial markets. End quote. But like I said, this time round, the United States appears to be seeking deeper, more structural and strategic concessions from these countries, not content with simply buying more American stuff. We are currently seeing a global trade and order reset. We are very much living history, and every day we are seeing months worth of news coming out. If you want to be on top of these important, salient and transformative developments as they occur every day, subscribe to Market Update and you'll be on top of the most up-to-date financial and economic analysis as it happens. If you're enjoying today's episode, don't forget to hit the like button. Meanwhile, Japan's top automakers and suppliers are joining forces in an unprecedented effort to catch up with Chinese rivals in the intelligent vehicle sector. Led by the ASRA consortium, which includes Toyota, Honda, Nissan, Denso, and chip makers like Socionext, the initiative focuses on developing standardized automotive chip designs aimed for deployment by March 2029. The goal is to cut costs and speed up development, as Japanese car makers lag behind China in the fast-evolving realm of software-defined vehicles, SDVs, and autonomous technology. Quote, "In terms of hardware readiness and functional safety, Japan is behind," end quote, said Nobuaki Kawahara, ASRA Executive Director. Unlike Chinese EV makers that prioritize software and adapt hardware accordingly, Japanese firms traditionally design hardware first, often delaying key chip and software decisions. This has hindered agility and contributed to a declining market share in Asia. Toyota's 2024 sales in China dropped 7%, while Nissan and Honda saw even steeper declines. ASRA's strategy centers on chiplets, modular microcircuits that can be combined to match various vehicle needs. The group plans to create base chip designs that can be scaled across models, reducing reliance on custom chips and helping car makers manage production costs. The effort is backed by a 41 billion yen, $286 million in government subsidies, and could eventually set a global standard. Quote, "If we can standardize the platform, chip production becomes more appealing to suppliers," end quote, Kawahara said. With fierce competition from China and limited leverage with major chip makers, Japan's automotive giants are hoping this collective push can help reclaim their place in the global EV and smart vehicle race. And finally for today, we move to Europe. This week, the European Central Bank, ECB, cut interest rates for the 7th time since June 2024, lowering its key deposit rate by 25 basis points to 2.25%. The move, widely expected by markets, underscores the rising threat that global trade tensions, especially those stemming from US tariff actions, pose to Europe's fragile economic recovery. In a press conference on Thursday in Frankfurt, the ECB president warned that downside risks to economic growth have intensified, explaining, quote, "It will take time to assess the full impact of US tariffs," end quote, referencing Donald Trump's recent escalation of trade duties targeting Europe and other global partners. The ECB's policy statement dropped the word restrictive for the first time in a year, signaling a shift towards a more accommodative stance. Investors now expect at least 3 more rate cuts this year, with the deposit rate potentially falling to 1.5% by year end. Market reaction was swift. The euro dropped 0.6% to 1.336 to the US dollar, and German bond yields eased slightly. The central bank president emphasized that the escalation in global trade disputes threatens to suppress exports and weaken investment, consumption, and financial market sentiment across the euro area. Quote, "We are entering a period of exceptional uncertainty," end quote, she said, noting that deflationary forces, including falling energy prices and a stronger euro, could drive inflation below the ECB's 2% target. The euro's recent strength, partly a result of capital flight from other regions hit harder by tariffs, has also put additional downward pressure on prices. Inflation in the Eurozone has slowed to 2.2% annually, with services inflation easing to 3.5%, providing the ECB more room to act. With Trump's 10% tariffs on EU goods in place for 90 days and uncertainty over future trade terms, Economists from Bloomberg, Goldman Sachs and Deutsche Bank all foresee further ECB easing. The European Central Bank president stressed that monetary policy will be data dependent as policymakers grapple with the fallout from protectionism and ongoing geopolitical volatility. Quote, "The neutral rate concept is meaningless in today's environment," end quote, she said, adding, quote, "We need flexibility, cohesion, and above all, reliable data to navigate what lies ahead." End quote. Okay, that is today's episode of Market Update, the final one for this week. We are now ready to move into what will be a big week ahead. Make sure you're subscribed for all of it. I think there's going to be a lot to cover in the next 5 or 6 days. Thank you so much, everybody, for watching. Have a great weekend, have a restful Sunday, and I will see you for a new week of updates tomorrow.